This weekend, we have many interesting topics to cover. The first is on the life insurance sector, where we will talk about the business models of insurance companies, how to value life insurance related companies, and what is the outlook for the life insurance sector. The second is investment gamification, where we will discover how game like elements can revolutionize your investment strategies for you to make more returns. The third is a 401k webinar, where we will talk about how you can manage your wealth and make your wealth creation journey much more fruitful with your 401k. So, if you're interested in any of them, click on the link below to register.
Setting return expectations, and we are going to talk on a subject which is so important to all of us, whether we are going to invest on our own or whether we are going to take the advice of an advisor or whether we are going to invest in a financial product based on somebody's recommendation or whether we are going to manage our own portfolio. Whatever we do, setting return expectation is a very critical aspect, because you are actually setting yourself up for success or disappointment, and the return expectation is going to be very critical in your journey towards the end outcome. So brother, let's start on this subject of setting return expectation. I remember that before I came into mutual funds, I was a direct equity investor, and people would share with me blogs written by various people, and I would read people say it's very easy to make 24% return in mutual funds, and I would think the GDP of India grows at 7%. How is it possible for somebody to generate a delta of 17% on that? And inflation at that time, even in the worst of times, was 10%. So how do you get 14% delta on inflation? But this was the kind of return expectation that I saw was being set in equities, and I am not going too far back. I am talking about 2008. This was what people were talking, and the investor was making his choice of advisors based on this expectation setting, because he thinks the person setting this expectation is a better choice for me than a person who says you will make 12 to 14% or 15%. So the decision variable was how the return expectation was set. It is another matter that those who set return expectation at 24% never made it. What happened was the blogs got taken down. Nobody really achieved that return. To my mind, I always believe in the principle under promise, over deliver. So when an investor starts a journey, he should actually have lower expectations, and because he has lower expectations, he is able to travel longer in this journey even when faced with adversity, either in the early stage or in the middle phase, and he stays right to the end when the outcome turns completely in his favor. And the interesting thing that I have observed is that since his expectations are low, he is able to harvest far higher returns than the expectation that was set. And this is a principle I swear by, whether I am setting expectation for myself as an investor or for anyone else, because behaviorally everybody tends to react the same way. When you think it's very easy to make high returns and you don't make returns, you start doubting your investment. Whereas when you set moderate target, you don't doubt your investment. You start believing it more when the valuation comes in your favor, and you do more things, and then finally the outcome comes better than the expectation that you originally set. How do you think the mutual fund industry has done its expectation setting right through these 30 years of private mutual funds? It's 31 years today.
See, there's a saying that expectations bring disappointments, right? So for anything, you join a gym and in 2 days you start standing in front of the mirror and flex your muscles. Nothing happens. You have to follow the process, and after 6 months, 8 months, 1 year, depending on your age, you see the results. Similarly, in mutual funds, if your expectations are too high, you are bound to be met with disappointments. So when you expect 12% and you get 15%, you should be happy. But when you expect 18% and you get 15%, you are unhappy.
Correct.
I used to write blogs, and there have been distributors who come to my blog and say, if I can't get 3% alpha for my client from the index, I don't deserve to be there. So some confusion of the distributor thinking he's a fund manager. He's not. He's not supposed to do this kind of expectation management. But what you said is right. People will go and believe those who say great things. They need not perform great things through every place. So if you think a bank deposit is paying you 7%, expecting a little alpha, which means about 10-11% in equity, is still okay. But remember, you are taking the risk, you have to be rewarded the return. If you don't get that 2-3%, which is 50% of what you're getting more in the bank. So if you're getting 7 plus 3.5, 10.5, 11, you will get. But when you set expectations which are too high, based either on immediate past performance or what the distributor is telling you, you're setting yourself up for disappointment. Secondly, return percentage matters only when you have a portfolio. So for a 22-year-old, till the age of maybe 50-55, he's just putting in money. So if he's getting lesser returns, he should be happy, because at some stage when the returns improve, it improves on the whole fund. It does not improve only on the last 1 year's thing, right? So if your NAV was 10, 11, 12, 15,
You are putting more money at lower
you're putting
NAV.
more money, more and more money at lower rates, and suddenly when at 55 you find that the NAV is 140 or 150, you should be thrilled, because out of the total corpus, your contribution is going to be small and the performance of the market is going to be large. So looking at returns when you are still in the investing stage, I'm actually saying something contrary to what people do. You should look at the number of units accumulated and not at the returns that you're getting. The lesser the returns you get, the better it is for you, assuming that the fund manager is good. But this is very counterintuitive. Everybody wants to be investing in the best fund. Even when you're watching television, you watch the tone of the person. He's very happy when the market goes up. And I tell those anchors, you guys are young. So when prices go up, you should be sad because you're a buyer. Who should be happy is the 85-year-old who is withdrawing.